Welcome to Trader TV Live in conjunction with FIS. Trading around events is fraught with risk and opportunity. With uncertainty around interest rate decisions, elections, and economic data outputs, we're discussing how the buy and sell side plan for scenarios to minimise risk and maximise returns. Joining me today are Sean George, Chief Investment Officer at Strukturinvest Fondcommission, James Athey, Senior Portfolio Manager at Aberdeen Standard, and Mattias Remnefjord, who is the Fixed Income Product Manager at FIS. Gentlemen, welcome to Trader TV Live.
Great to be here.
Thank you. James, could you start off by telling us what sort of scenarios you have to plan for if there's a central bank interest rate decision coming up?
Sure thing, yeah. Unfortunately, Dan, gone are the days where, it was a simple case of are they on hold, are they going to cut, are they going to hike? We now live in a world of sort of overt central bank communication, and that means we need to consider some of the options in between, which is to say we have these slightly spurious sounding concepts like a hawkish cut or a dovish hold. So actually the number of options is a little more complicated, but essentially, our behaviours, the analysis that we have to do around those risk events is a microcosm of what we're trying to do the rest of the time. And that's really around two key concepts, and that is valuation and asymmetry. So essentially what we need to understand is what are the market's views of what's likely to happen? What are the market's views of the market's likely response to those events? Where is market positioning? And therefore we can try and understand where the risks are around positions that we may be running, which may be affected by the outcome of those decisions.
That's very good, thank you. And Sean, as a hedge fund, do you think about things differently in any way?
I mean, we go about things differently. I mean, we have, some of our positions are longer term, like theirs, but at the same point in time, there can be a fair amount of alpha to collect after an event. But the way things have shaped out this year, there's been, the reaction function that we've assumed when we've modeled what we think is going to happen in the different scenarios, and then we have a portfolio set up for multiple scenarios, and the reaction function is something completely different than what we had modeled, and so we are more patient at this point in the year because we want to see the market reaction play out. And we've just let it run sometimes because we don't agree with the market reaction, but it's worked out with our position. But we generally try and collect alpha and be a little bit faster than other people. Thus the nickname Fast Money for hedge funds.
Absolutely, of course. And Mattias, how do you see sell-side counterparts potentially preparing to assist their buy-side clients and also, of course, in the interdealer market?
Yeah, I mean, if you have like an event like this, like a rate decision and the outcome of that, it's very important that when it heats up that the sell-side banks have their sort of trading system lined up in terms of position management, but also that they have figure out a little bit beforehand their risks with that sort of move. I mean, if there's a rate decision, there might be a steepener or a flattener, or if there are some moves around the curve, some 2, 5, 10 flies, for example. It should not be such a surprise if there is a certain sort of steepening of the curve, the outcome of that. And I mean, that's the change of the curve, but then you also have the different ways to look at from the credit side, from the issuer, so that they need to keep track of what happened if the spreads are widening. If you have the triple C versus double B, for example, to look at that from a CDS side. And also nowadays you need to keep track of the liquidity and the funding side. To see these kind of basis risks, what you might be exposed to. We saw that the end of September in US when they had the liquidity squeeze there in the repo market. And but when things heats up, it is very important that the sales banks can still sort of provide the service to the buy side in terms of contributing prices to the extent that they want to. Okay, I mean, if it's a shaky market, maybe they pull back, but we've seen that it can pay off if you're out there in the market, even in a shaky situation, that you've been there when it sort of heated up. Yeah. But also from a pricing perspective, when you're trading several different asset classes, it's very important to have like consistent pricing across different segments. If you're trading corporate bonds, governments, but also if you mix that with things like on the swap side, cross-currency swaps. So you need to have a consistent pricing and a good view. But in terms of a decision, the P&L impact should not come as a surprise. You should have done your homework before.
Sure, that's very good, thank you. And James and Sean, what sort of information do you use in the preparation phase for this from your bank counterparts?
I mean, I'd say it's an ongoing dialogue for us, at least.
Okay.
Understanding market positioning is a big point. Understanding where the weakness is. Understanding, like we've had many accounts have had good years this year. And we're at the middle of November.
Yeah.
The risk-taking, appetite right now is not great. And it's not great at the bank side going into year end. And many banks have also had good trading years. So just understanding the market dynamics and being prepared for their impacts on pricing. And there's been a lot of things this year that have reacted very strangely, but you have two central banks in the market as well. Yeah. And then you have accounts, buy-side accounts like us, reacting to what they're doing, agreeing or not agreeing. And those dynamics are not something that you get delivered to you. It's an ongoing process of dialogue across the counterparties or even some of my competitors, which I'm friendly that I talk to.
Sure. And James, what sort of information are you using in the long only position?
Yeah, sure thing. I mean, Sean's hit the nail on the head. Essentially, we're using the street because in aggregate, they see a heck of a lot of flow, if not all of the flow, and us as a single buy-side firm, we don't have access to that via any other means. So first and foremost, as Sean's already said, there is an ongoing dialogue, but particularly when there are risk events, particularly when there are known events in the economic calendar where there's likely to be volatility in the aftermath, it becomes that much more important to have had these conversations, to understand who's been buying, who's been selling, where the positions may be, where, again, back to the asymmetry, where's the asymmetry around potential market moves in the aftermath of the decision. So absolutely, that's a key input for us in being able to sort of build that deep, textured view of exactly how the market is positioned and how it's likely to behave under various scenarios after the event itself.
Okay, and what's the biggest risk do you think you face in the planning stage?
Sure thing. Well, obviously not having the right information is a huge risk. There are markets have become incredibly complicated, not just in terms of central bank distortions, which are a huge issue, but also in the number of instruments and the potential uses for those instruments. Because we have more liquidity in the system, trying to make comparisons through history about the extremity of positioning is difficult because you're comparing under two different scenarios. So it could be quite easy to have a view on positioning which turns out to be somewhat false because the context isn't right.
Is that the same for you, Sean? Yeah,
I mean, our problem is it's exactly what I said. Our biggest position from the long side is CSPP bonds that the ECB will actively be purchasing, hopefully the exact bonds we own, but bonds that fit in the framework. Yep. Modeling that is absolutely impossible. Like, how is that asset, or how's that part of my portfolio going to perform going forward? Because I have really from June forward with these particular bonds, and then I have the last time, but the last time they were in was a completely different scenario than it is now. So understanding and tweaking and using the right proxies, and then you get what we get back from the model, and then we have to actually haircut that because the volatility is actually higher a lot of times than it should be in the model, because it's not taking into account that the ECB will be there when the volatility picks up. And I have a young quant with me who's very, very bright. But when you haven't seen these cycles, I've been doing this for almost 24 years now. Volatility, it's understanding what the model says and what the actual volatility is different.
That's great, thanks. And I think we're going to talk about trading next. I'd like to thank Sean George, James Athey and Mattias Remnefjord for their time and insights, and of course you for watching. To watch the next section of Trader TV Live, go to tradertv.net.